Hello, this is Harlan Mayer, Principal Real Estate Broker, and you were watching here on creative1031exchange.com, and you're also on the Portland Property Channel. So go ahead and like and subscribe if you'd like to learn more about value and saving money in investment real estate and being creative so that you can swap till you drop. Okay, if you are in Portland, Oregon, my local website is www.realestatepdx.com. And today I am meeting with a gentleman who is a cost segregation expert. That's why you're here. And this is Richy Trum. Hello, Richy. How are you today?
I'm doing well, Harlan. Thank you for having me on the call.
Right. I really appreciate you coming on. And Richy Trum, they call you the cost segregation guy, don't they?
Yeah, that kind of started. I have a lot of referral sources. I work with a lot of brokers and tax professionals all across the country. And one of my brokers sent me a referral, and the guy said he was looking for the cost segregation guy.
Okay.
So you just kind of stuck. So
I like that. So let's get right into it, because people are asking the question, what is cost segregation?
Yeah, cost segregation is essentially, it deals with depreciation expense on commercial buildings, and that's tied to what you paid for it. So whatever you pay for the building. And what a study does is actually segregates personal property and land improvements, which have a different class life or depreciable life than the building. So in this example, the top example is without doing cost segregation, you spend $2.9 million on a property. The building cost, which is very important to understand, that we do have to back out land. Land is a non-depreciable asset. But in this first case, you're essentially depreciating that building. Looks like an apartment building over 27 and a half years. So you're only able to write down roughly $75,000 per year in depreciation expense. But by using the cost segregation study, we're going to change the bucket structure a little bit. So you're going to have roughly $1.5 million in building asset. And then we're going to pull out personal property, which could be like certain types of flooring, crown molding, baseboards, specialty lighting, specialty plumbing, cabinets, different types of fixtures. Typically, it's going to be about 15 to 20% of a building. And so now we're going to have a bucket with, in this example, about $500,000 in assets that can be depreciated over 5 or 7 years. And then your land improvements are anything that on the outside of the building. So that'll be typically parking lots, sidewalks, landscaping, curbs, even the sign outside by the front of the road. Those can be all reclassified. So anytime you can depreciate something faster, it's going to give you more expenses to write off. It's going to basically cause a cash flow increase due to tax savings.
Gotcha. Speaking of which, you are not a tax professional, nor am I. And so this information is for educational purposes only, correct? We always want you to talk to your CPA about any of these ideas. These ideas are vetted ideas, but you need to bring them to your professionals and make sure they're right for you.
Yeah, 100%, because we're not accountants per se. We do engineering studies. And your tax pro has information or is privy to your taxable information. We're not. So just want to make sure that it's a fit.
Right. Perfect. Okay. So getting to the maximizing tax savings, exploring cost segregation strategies for optimal depreciation benefits. You like that? That's the title of our talk. So you've talked about what is cost segregation. Okay. So how much in taxes can it save me?
I use a rule of thumb of 5 to 7% of the acquisition cost, and that is minus land. So, for example, if you pay $1 million for a duplex, a rule of thumb is about 20% for land allocation. So that leaves us $800,000 in depreciable assets. You take that 800,000, multiply it by 5, and gives you about 40,000. So a building like that would save you about $40,000 at the 37% tax bracket. And we always prepare a no-cost predictive analysis for our clients to kind of show them a more personalized tax savings potential for them.
Gotcha. Yeah. So you do a just a no fee, just rough draft, see if it's even in the ballpark for them.
That's correct. Yeah. The only thing that we would the easiest thing for us to get to be able to provide that is a depreciation schedule. The most current one is not. If a depreciation schedule is not available yet, we would just need the purchase price, the address, and the purchase date, so we can make our calculations. Doesn't cost anything to do that.
Got it. All right. So let's see. We're going to do questions. That's right. So what is the minimum size building that you can study?
I would say around $250,000 in depreciable basis. Anything less than that is most likely not going to be cost effective, because we do have a minimum fee. I mean, we're putting engineers to work to do this. So, there comes a point in time where you might spend more money than you're going to save. So about 250 is the starting basis.
Okay. And you can do a long-term, short-term rentals here.
Yeah, you can. A lot of people don't know this about, their long-term rentals, but they're 27.5-year assets. So our studies work great for those. And we're seeing a very large number of professionals getting into the short-term rental business. And those have a 39-year depreciable life. So they can be really good for cost seg. Gotcha.
Okay. Defining a target. Can I study any improvements made?
Yeah, you can. It really depends. Most of the time you can do that. So for example, let's say you bought a building for $1 million and you put $250,000 into it. Yeah, we would study those improvements right along with the study of the original asset. And there's no minimum basis for the improvements, as long as we're doing them in conjunction with the original building. If you maybe bought a building and did a study on it 3 years ago and you put the $250,000 into it, that standalone we could actually study, but we would want to see at least $150,000 as a basement, to make it worthwhile or cost effective to do. But yeah, most of the time you can definitely study the improvements.
Most of the time.
Yeah.
Okay, so what is bonus appreciation? You hear about this all the time. Anyone likes money. It's money that you're going to lose, right, if you don't use.
Yeah. So bonus appreciation has been around for a while. Back in 2012, bonus was made 50%, but it was only for new construction that you actually own, that you constructed and built and occupy or rent. Bonus depreciation from the Tax Cuts and Jobs Act of 2018 basically will give you an immediate write-down of any assets that have a depreciable life of 20 years or less. So when we are studying a building, we're breaking out 5, 7, and 15-year assets. And because of that, they're now eligible for bonus. So if you bought a building that's 27.5 year and you don't do a breakout, you cannot take advantage of bonus depreciation. You would have to break it out some kind of way. People ask me, well, do I have to do a study? No, not necessarily, but it's the best way to break it out that I know. I mean, you could have a CPA guess, but I wouldn't sleep real well if I had my CPA do that. Besides that, it's a conflict of interest for them. But with the new Tax Cuts and Jobs Act, one of the things that was made available for the first time was we could take bonus depreciation on used assets. So you can buy a 50-year-old building today and take bonus depreciation on it because it's new to you. And so the bonus depreciation that's available today from 2018 until 2022 was 100%. In 2023, it's 80%, and it will be phasing out 20% per year until it's basically phased out.
Yep. So get it while it's hot.
Absolutely. It's a fantastic tax benefit to take advantage of. And we're seeing a lot of people not do that. I don't know why, but most of the time it's just because they don't know about what we do.
Yeah. Yeah. Oops. Let's see. All these people all the facts come together, like they all start to add up. And all of a sudden you have more because you watch the details, and you can do more investing is what our goal is, or my goal. Yeah. I hope it's your goal, but anyway.
Well, I mean, we see a lot of people take these tax savings. I mean, I just did a non-building project where we saved the client over $400,000. They turned right around and purchased a new building with it. Used that money to segue into a new asset. So
Exactly.
now we're compounding interest on top of interest. So it gets really good.
What you're doing is you're taking your interest and you're reinvesting that. So it's and in today's prices, not in prices in 2 years.
That's right.
So I appreciate that. And this is why we like creative things at �creative1031exchange.com. Okay. So what is a PAD?
PADs are really good. PAD stands for partial asset disposition, and it goes back to these improvements. So if you say same example, you own a $1 million, let's say you have a hotel and you spend $250,000 in improvements. During the course of the renovation, you're throwing assets into the dumpster, and those assets have value. And if you don't write those assets off your depreciation schedule, you're going to be continuing to depreciate ghost assets, and we'll have to pay recapture tax on those assets if you sell the building, assets that no longer exist in the building. And so what you want to do is take the partial asset disposition. Even if you're selling the building, you can do that, and not do a study, just do the PAD on the renovation, so you can get the immediate write down of those assets that are disposed of, as well as, to be able to take advantage of not having to pay recapture tax on those assets that are left on your books. Right. So a couple of things to note about PADs. You have to take the PAD in the same year that you take the renovation. And you also have to take the PAD in at least 1 year after your first year of depreciating. So let's say you buy a building in 2022. And if you start making renovations in 2022, you cannot take the PAD. But if you do the renovations in 2023, now you can take the PAD. So you have to depreciate the building at least one tax year, and then you can take the PAD.
And all these timelines get very overwhelming. I mean, even a creative 1031 exchange, we look at a lot of, 1031 exchanges. People ask me about creative ways, and I say, why don't you start early? Why don't you know where your money is going before you even think to sell anything? That's our rule. Like, you should know your market. And in this, you should know your taxes. And this is one, a lot of people, they're just a lot of opportunities that people don't even know about. Once you start taking advantage of them, you start to pad your investment portfolio.
Absolutely. Yeah. And unfortunately, tax professionals are very busy. It's not their fault per se that they don't know a lot about this, but this is what we do. This is what we focus on. So, our expertise is, an inch wide, but a mile deep. Whereas a tax professional, theirs is a mile wide and an inch deep. They need to know a little bit about everything. Right.
This is the kind of thing they would learn about in continuing education and either get it or not. And I think that from the book Rich Dad Poor Dad, I'm not commenting on the man himself who wrote it, but because he's got some wild views, but I'm commenting.
He's a big proponent of Cost Seg, by the way.
I know he is for sure, because this falls into the whole. I'm just saying, I'm not saying anything about anybody in particular, but one of the rules, because I like to look at the rules and not the people behind them. So he's one of those people that got really intermixed with his own work. Yeah. But he taught me, if you want to know more about something, surround yourself with people who know more about it than you do.
Yeah.
And I really liked that. And it brought me into, that's why I have a great team. I have a great CPA, I have a great attorney, I have a great, estate attorney. We're going to be covering estate plans because, that affects your direct.
Yeah.
What you're leaving if you're not leaving your estate a stepped up basis portfolio, then you're not paying attention to taxes at all. And some people just.
And now you need us, so you mentioned the tax attorney and the CPA, and you need a good depreciation expense expert.
Absolutely. It's such a crucial part of the savings, and what it allows you to do both physically and mentally is afford more. You can afford more real estate because you're saving more money. Saving money is making money is one of my favorite.
It's compound interest. And Einstein said that compound interest is the eighth wonder of the world. You're either using it for you or it's being used against you.
But let's remember, though, this is money that, a lot of people let go and they don't even think about. It's just something that happens in their CPA. It's a mystery. We don't look at the details because it's overwhelming, but that's why we have experts.
Yeah. And we also like for our clients to bring us in very early in the conversation so we can kind of help them navigate some of the pitfalls that they might experience without us before they go down that road too far.
Exactly. All right. Well, that was a pad. I just want to remind everybody that they can go to 1031 Exchange, creative1031exchange.com, and download the 10 reasons you want to cost segregate. And you can also, if you email me, you can get a copy of this presentation. All right. So getting back to business here. Oh, we were there. What is is it not a Q-tip? It's a QIP.
QIP. Yeah. Years ago, there was something called qualified leasehold improvements, qualified restaurant property. Back with the Tax Cuts and Jobs Act of 2018, they started this new thing where they basically pulled all those together and called it QIP. And essentially what it is, it's an improvement to the interior of any non-residential real property. And these are typically assets that would be more 39 or 27 and a half year assets, like HVAC, electrical, fire protection, alarm, doors and frames, painting. Those are normally 39-year assets. But with QIP, we can look for those and identify those assets that can be used for an immediate write down. So what it does is a QIP, if we deem it a qualified improvement property, essentially is a 15-year asset now. So they're 39-year assets. They go in the interior of a building, and then they're reclassified as 15-year assets. And what happens then is all of a sudden now they're eligible for bonus depreciation. So it's really cool.
Okay, that's how you get to the bonus depreciation in that respect. All right.
Yep.
That sounds good. Okay, let's see where we're next. Okay, so depreciation study. So you have to do a depreciation study if you're going to enter into this type of technical tax code.
Yeah. So, we get a lot of common objections or concerns from our clients. And one of the biggest ones that we get from tax professionals is telling their clients, well, you're going to get all that depreciation expense anyway, right, over time. The problem with that is that you're only taking a teeny tiny amount of that depreciation expense, which doesn't even really keep up with inflation. So we know that the time value of money is why you would want to do this. So having the cash available today to reinvest takes us back to the whole compound interest thing. And if you won 39,000, I'm using 39,000 as an example because of 39-year assets, but if you won $39,000 today in the lottery, would you want the 39,000 cash today? Or would you rather just take $1,000 per year for the next 30 years? And if you put those in a bucket, which bucket is going to have the most cash in it at the end of 39 years? And so you realize how not real on track that argument is about, well, you're going to get it anyway. Yeah, you're going to, but it's not. We can structure it better to optimize the depreciation expense to give you more cash flow.
Yeah, make money before you make money.
That's right.
Okay, so we can go through these real quickly. Some more questions. So you just really quickly run some. These are some of the questions I had.
Okay. Will I pay recapture tax if I sell the building? You're always going to pay recapture tax. And the question more specifically would be if you do a cost seg study. That's what a lot of CPAs will tell you. Well, you're going to have to pay recapture tax on that depreciation expense.
Right.
What they don't understand is that if you sell the building, you will pay recapture tax. And so essentially, you're taking depreciation expense deductions against your income. It's saving you taxes. So when you sell the building, the IRS wants you to pay that back. And those personal property that we segregate out, the recapture tax rate is at the ordinary income tax rate. So it could be substantial. But just remember, if you sell the building, you're going to pay recapture anyway. You might pay a little more early on if you do a study because you're taking more expenses. But just remember, you'll never have to pay back more than you took. Let's say you had a $1 million building and you've taken $200,000 in depreciation expense. You sell the building, you're going to have to pay the $200,000 back. Okay. So we recommend that our clients, that they hang on to the building for at least 3 to 5 years. It also depends where in the process or how long they've owned the building itself. But that should not be a reason not to do cost segregation. That should be a reason just to to make sure that it fits, just to make sure that we're doing the right thing.
Yeah, you have to do your due diligence, and it's essential due diligence is what it is.
Correct. Yeah, it's not a one size fits all.
Essential due diligence to make sure you do a study on this. So this works obviously for 1031 exchanges. If it's
It
over,
does, yeah. Another misconception I'll say is prospects that I talk to that have done an exchange, and they say, I don't need a cost seg study. I'm already deferring. Well, you are, but you're deferring capital gains tax. Your capital gains tax and your depreciation expense are two different things. They're very different. So, in a 1031 exchange, you're deferring capital gains tax. Right. Typically, the unused portion of your depreciation expense is going to carry forward. And then the difference in the price of what you sold the old building for and what you're buying the new building for is going to create a new basis. You combine those together for a new net basis. And if that new net basis is over $250,000, then absolutely we can look at doing a study.
All right. Okay, so will this help me offset capital gains tax?
It could, indirectly. Your capital gains tax rate is based on your income. Capital gains tax, I believe, it's 0% for under maybe 75,000. I don't know the exact numbers because they change. And then if your income is over maybe 450 in that range, you're going to pay 20%. There's also a bracket in between that's 15%. So if a cost segregation study can lower your tax bracket, then chances are it can lower your capital gains tax rate. So not directly, but indirectly it could. Now, if most of your income is so high that we can't affect it, then you're not going to be able to affect it. You can still save money on your tax bill by doing the study. It's just not going to help you as much with the exchange.
I like that though, that you could lower your tax bracket. This could push you over the edge.
That's correct.
To a different tax bracket. So can I do this every year?
You cannot do this every year on the same building.
Right.
That's a great question because a lot of people say the same thing. Once they understand, that they can spend $4,000 or $5,000 to save $50,000, they say, well, how many times can I do this? Well, unfortunately, you can do it once because we're breaking out the percentages of property. However, moving forward, let's say you do a $150,000 and above improvement, we can study that again, brand new, all day long. So every time you do an improvement, you can do another study.
Got it. And will this affect my W-2 income?
It could in some cases. There are some active passive rules that we have to look at here. So when you're in a passive income situation where you're renting a property, that's a passive endeavor, a passive activity. Passive income you cannot create a net operating loss on a passive side, but you can on an active side. And so there's been some rule changes. There is one designation called a real estate professional, which is I think 750 hours or more in those real estate activities. There's some other criteria that go along with that, but it's called a rep. And if you're a rep, all of your rental activity, those passive incomes can be offset and affect your active income. Also, we're seeing a lot of the short-term rental purchases by professionals because there's a rule called it's a material participation rule, where if you spend 100 hours or more per year managing and overseeing that property, and you spend more time than anybody else, you can count the passive income as active, and so that can reduce your W-2 income. The only other thing that I know of, and there's probably more, but it's something called grouping. And grouping essentially is if you say you're a dentist and you own a building with your partner, and I'll go back one slide there. Two dentists, 50-50 partners in their practice, so they have an operating entity. They also own the building and rent from the building that they also own together 50-50. It has to be the same ownership, same exact ownership to qualify for grouping. They can elect to group those activities of the operating entity and the holding entity, and now the passive rental income or losses can be treated the same as their active income. This has to be done in the first tax year of ownership. Once you have made this election, even if you don't elect a group, you've made the election and you're stuck with it. So another thing that we like to do is get on the front end is with our clients is, if they're going to group and it's a brand new acquisition, to group now, even if you don't need to have the study done this year, that way you'll be prepared for the study the next year so it can affect your active income.
So what you're saying is it's an ounce of prevention for a pound of cure.
Yeah.
To study.
Definitely.
Study is very valuable.
Of course. And we I look at this more of a being in a consultative capacity, not just a salesperson. We want to get in and really, get to the root of all the details that are involved so that we can better guide our clients to make the right decision.
Well, we're in the relationship business. So
that's right.
Yeah. So moving on, the last thing I had a question about was the short-term rental loophole, because everyone's Airbnb-ing everything.
Yeah.
Their sisters, everything.
I mentioned this earlier. I hate to even call it a loophole, but that's what it's kind of been dubbed.
It's not a
loophole. By the people that are doing this. It's just, it deals with material participation rules. You can actually download the material participation publication from the IRS's website. There's 7 different tests, but you only have to pass one test. And the easiest test is to materially participate in that activity for at least 100 hours per year. And you want to document that, especially if you're a doctor or lawyer professional. And you invested more time in that activity than anybody else. At that point, you can treat the passive activity as active. And so that's another way to, affect that W-2 income.
So could this trigger an audit? Is this going to raise suspicion with the IRS?
I would say that it could. It typically doesn't, because essentially what you're doing is you're now depreciating your building the correct way. So if you buy a building at 39 years, you've got 5, 7, and 15-year components of that building that are being depreciated over 39 years. Essentially, you're depreciating it wrong. So by segregating your building and putting it the way the IRS or the tax code wants you to, I would think would not cause an audit. The company that I'm with, we've been around for a long time, done over 30,000 of these studies. To our knowledge, they have never triggered an audit. We do provide audit representation to all of our clients, meaning if you're ever brought into an audit, we will show up in court if it needs to be to substantiate what we have done. Yeah.
You're going to back up your work.
100%. We'll stand behind it. Now we have been brought into, I think, 12 or 13 different audits, and we've never had one of our studies overturned, ever.
Great. So Richy, I want to thank you very much for joining us here on creative1031exchange.com. I hope you swap till you drop. And, they say that there's only 2 truths in the world, death and taxes. But if you have a revocable trust and you get death, then your children don't have to pay taxes because they receive it at a stepped up basis.
Yeah. And let me make another point about that. That's a great point that you bring up, because if you're going to hold on to your building and pass it along to your heirs, you can do a cost segregation study. When you die, there is no recapture. And now your heirs can turn around and do another cost segregation study and continue to defer those taxes. So it's one of the only times that I've seen where you can actually kind of double dip.
Double dip. That is very rare. Yeah. Yeah. We have in the sales game, sometimes you can get a trifecta, but double dipping is great as well. So I want to thank you for coming on, and we'll have you back. And thanks so much for your time. Okay.
Yeah, my pleasure. Thank you for having me.
All right. Okay.